Investing in bonds. A bond is a loan that pays interest over a fixed term or period of time. When the bond matures at the end of the term, the principal or investment amount is repaid to the lender or owner of the bond. Typically, the rate at which interest is paid and the amount of each payment is fixed at the time the bond is offered for sale. That's why bonds are known as fixed income securities. It's also one reason a bond seems less risky than an investment whose return might change dramatically in the short term. A bond's interest rate is competitive, which means that the rate it pays is generally about the same as the rate on comparable bonds being issued at the same time. The rate being paid is also determined in part by the cost of borrowing in the economy at large. So when interest rates drop, for example, rates offered on newly issued bonds also tend to be lower. Let's talk about the type of bonds. You can buy bonds issued by U.S. companies, by the U.S. Treasury, and by various federal, state, and local government agencies. Many international and emerging market companies and governments also sell bonds to U.S. investors. The life cycle of a bond. So the life or term of any bond is fixed at the time of issue. And it can range from short term, typically a year or less, to an intermediate term, which is about 2 to 10 years, to long term, 10 years or more. Now, the relationship between the interest rates paid on short-term and long-term bonds is called the yield curve. Generally speaking, the longer the term, the higher the interest rate that's offered to make up for the additional risk of tying up your money for such a long time. When that's the case, the yield curve is described as positive or upward sloping. For corporations, issuing a bond is a lot like making an initial public offering of their stock. An investment firm helps set the terms and often underwrites the sale of buying up the issue. In cooperation with other financial companies, the investment firm that offers the bonds for sale to the public. When bonds are issued, they're sold at par or face value, usually in units of $1,000. After issue, bonds trade in the secondary market, which means they are bought and sold similar to the way stocks are traded. The issuing company gets no money from these secondary trades. How do you make money in bonds? Well, conservative investors use bonds to provide a steady income. They buy a bond when it's issued and hold it till it matures, expecting to receive regular fixed interest payments. When they get the principal back, they typically reinvest in another bond. More aggressive investors trade bonds or buy and sell them as they might stocks, hoping to make money by selling a bond for more than what they paid for it. Bonds that are issued when interest rates are high become increasingly valuable when interest rates fall, and the opposite of true is true well. That's because investors are willing to pay more than face value for a bond with a 6% interest rate if the current market interest rate is 4%. In this way, an increase in the price of a bond or its capital appreciation often produces more profits for bond sellers than holding the bonds to maturity. But there are also risks in bond trading. If interest rates go up, you may have a capital loss if you sell an older bond that is paying a lower rate of interest. In that instance, potential buyers will typically pay less for the bond than you paid to buy it because, well, they'll be earning less than the current interest rate. In bond ratings. So who use ratings? Well, individual investors will use credit ratings to help make purchase decisions that are in line with their risk tolerance. In addition, they may want to check what they could reasonably expect to recover if the issuer defaulted. In addition, issuers themselves use these credit ratings to provide an independent verification of their creditworthiness and the credit quality of their securities. But what actually gets rated? Well, the rating services evaluate government, municipal, corporate, and international bonds and structured products. Rating services, they don't evaluate market risk or the impact that changing interest rates will have on the market price of a bond that you sell before maturity. Even the highest rated bonds and U.S. government issues are vulnerable to loss of market value as interest rates rise, or in many cases, if the issuer or issue is downgraded. And there are rating systems, and in these rating systems, there are 4 top grades that are considered what we call investment grade, and those lower rated are considered speculative. Those with a rating of C or lower are often referred to as high-yield bonds, as the issuer is generally going to have to pay a higher rate of interest to attract buyers. Time is money. So when bonds have the same credit risk, but different terms, or until they mature, those with those longer terms are going to typically pay higher rates to encourage investment for an extended period, which means greater potential for inflation, interest rate, and default risk.